Success and Money Foundation. We're a nonprofit foundation. Our goal is to help you and your family to have a better life. And the question is it good or bad when stocks go down in value? Is that good or bad? That's kind of a crazy question. Is it good or bad? Is it going to happen? Of course it's going to happen. Law of supply and demand. Money chases, stuff's go up in value or goes down in value depending on how much demand and how much supply is available. So that's something to be thinking about. And I want to talk a little bit about dollar cost averaging. How does dollar cost averaging work? And riding the roller coaster. Now, some of you guys look at the roller coaster and you think it's this roller coaster right here. That's a crazy one right there. I don't ride those roller coasters. I used to when I was a lot younger. My grandkids love them. My little 8-year-old granddaughter just cried if she couldn't jump on those crazy rides when we went to the amusement park. But I don't do that anymore, but I used to. And we need to create the right journey for you and get you on the right ride. I'm going to talk about that. Now, is the stock market going to go up and down? Of course it is. Why? Because of supply and demand. You have cash, you have stock, you have real estate, you have Bitcoin, you have all these different investments that people have access to, real estate. And it really goes back to the supply and demand. The supply, how much supply is out there and available, and how much demand is out there. It's really important that you really comprehend this concept of supply and demand because it runs everything. It really turns and runs everything. So we're going to jump over here to our little notepad right here and let's talk about the supply demand for a second. So you have many different things. You have cash. Okay, Josh, is that dark enough for you? Need to be
Yeah.
darker. Okay, you've got cash, you've got real estate.
Yeah, that's good enough now.
Okay, you've got stocks, and you've got crypto. And so you have so much cash, and when stuff is hot and people are excited about it, they're taking their cash and dumping it into stocks. When a lot of money's going into stocks, the value goes up, the price goes up because you have a lot of money chasing a limited number of stocks. But when people are afraid of stuff like they're a little bit right now, then they've turned and gone the other direction and says, well, I'm taking my money out of the stocks and I'm going to put it back here to cash. So what happens to the value of the stocks? Well, it can go down. Now, this is a very simplified version of that. But you look at other stuff like crypto, there's all kinds of, there's Bitcoin, there's Ethereum, and then what I'm going to call the crap. Okay, I'm not even going to put it on there. I don't even like it. Okay, so when there's a lot of money going after these, guess what? The value goes up. When money goes the other direction, hey, I'm not that excited about it anymore. It goes the other direction. So I'm taking that and I'm putting it back here or moving it to someplace else, then it's going to go down. It's all about supply and demand. And so the more of something you have, it's all connected to the supply and demand curve. Okay, that's huge. That's a big part of that. Now, if we come back here, and we're going to take this all off here, right here, and let's look at what happens to real estate. When interest rates are low, then more people can buy property. So there's more people that are chasing it when interest rates are low. So a lot of people want it. So what happens to the price? Price goes up. But what happens when interest rates go up? And it's hard for people to be able to afford it or to be able to buy it. Guess what happens? Then the prices level off or they might even go down. Now, in the stock market, for example, what's interesting about the stock market is what stocks are you buying? So I'm going to come back in to look at that for a little bit on the supply demand curve right here. So if you have if you have one company, it can go up, it can go down, it can go sideways, and it can do all kinds of things because of supply and demand. It can come up, it can go down, all because of supply and demand. Okay. Now, if you have 500 companies, then it's going to be a lot more stable. You're not going to be on that roller coaster. If you are just doing one company, that's the roller coaster. Supply and demand, boom, boom, boom. You can see craziness right there. But if you've got 500 companies, it's going to be a lot more gentle. So as your asset allocation, you're going to either loan or own. You're either going to loan money to the bank. You put money in the bank, you're loaning them money. Guess what? They're taking your money and they're going to go back out and they're going to go and do something with it. Okay. And they're not going to pay you anything for it. So your money's not making you any money. You can do bonds. You can do longer term loans like that. And you're going to get probably 0% rate of return here, and you might get 3% rate of return here. Now, what can you own? Well, you can own stocks. And the reason we like stocks is because it's fast, it's easy, and it's quick to be able to get started. Okay, you can own stocks. You can own crypto. You can own real estate. You can own businesses. And you can own little parts of those through the stock market. Some of you don't really want to do real estate, but you want to invest in real estate. Well, you can buy the stock. You can invest in some of the companies that are there. Now, when we talk about the stock market, the reason we like the big S&P 500 and Berkshire is because that they're big companies. They have all kinds of smaller companies that are part of that. Berkshire right now has between 350 to 400 billion dollars in cash waiting for some incredible deals. They're sitting on the sidelines. So if you want to invest in a company that is poised to take advantage of hopefully a crash, then Berkshire is a great place to be, because they've got so much money just in cash. They can pull a trigger and then go buy stuff. And he loves to buy wonderful businesses at a fair price. Now, what's fair to him? He's looking for a bargain. He loves it when he can buy stuff for very low. Okay. That's why we like Berkshire so much. And so if you're on this roller coaster, and that's the problem, if you have one stock in some company that's a startup company, supply and demand that's gonna put you on the roller coaster. If you love the roller coasters, great. But if you have invested in a company where there's 500 companies, it's going to be a lot smoother. Now, is it possible to go down in value? Absolutely. Look at here. This is the annual return for the last 20 years. Now, you can see there's some really great years and there's some terrible years. You've got one year right here in 2007 where the stock market went down 38%. Where'd that money go? It went somewhere else. It went somewhere else. They took that money and they took it out of the stock market and they put it someplace else. And then you can see that it bounced back here. It had a negative right there. It's gone up. It's gone down, gone down. So this is, look at it. You can actually see the roller coaster. Boom, there it goes right there. Now, is the stock market going to go down in value? Absolutely, because money's chasing something else. So just know that that's going to happen. Now, is that good or bad? Well, I think it's great because we have a thing called dollar cost averaging we're going to talk about. But let's talk about the next thing. Here is, what's happened after a major geopolitical event. And this is looking at the Korean War, Cuban Missile, Six-Day War, Gulf War, stuff like that. What happened? Well, those had a negative effect, but what happened a year later? Within 1 year, they went down, but what happened a year after that? You can see they're bouncing back up. They're bouncing back up. Now, why are they bouncing back up? I mean, there's COVID. COVID must have had a pretty good dip to go back up 43%. It's all about supply and demand. People took their cash, they took their money, they got out of the market, and they put it into gold and put it into other stuff that was to them was more safe. They got off the roller coaster. Now, I don't recommend you. I don't have any problem with asset allocation. We've got people, some of our students are saying, hey, I just want to get out of the stock market. Okay, well, that's asset allocation. If you are not comfortable on the roller coaster and you would like to try and time the market, okay, you have the ability to move money back over here. Okay, there's nothing wrong with that. Buffett has 350 to 400 billion dollars sitting right there in bonds, treasuries, US treasury bills. That's probably making him probably 3 to 5%. Okay. And he's okay with that. And then he's looking for a great deal, hoping that there's a market crash because he wants to come in and buy up wonderful companies at great prices. And he's kind of the extreme. He's looking for that. That's what he's looking for. So let's go back here and look at what we've got here. So has the market crashed? Well, yeah, it has. 1929, the Great Depression, that all really started, and that's really what created World War II. Part of that was that what happened because of World War One, but the stock market went down dramatically. Money chased something else, and it wasn't what it was credit. Credit dried up, and so people weren't able to finance anything. They weren't able to put product on their shelves, groceries, whatever it was. But what happened after? Well, you can see it bounced back up. So this is an extreme roller coaster. And you can see there's 7 times in the last 100 years where it really crashed. But then what happened right after that? Well, it went back up because of supply and demand. Okay. That's why it did what it did. Okay. So the real question is, how is this being affected with Iraq and Iran? Iraq and Iran are kind of two ends of that same group right there. And how does it affect you? How is that war affecting you? Well, crisis is two things. It's one is opportunity. There's opportunity in anything. The problem is that people get scared because of what's going on with that war. And so what do? They take and they move their money to something that's more safe. They're putting it into gold, or they're putting it into which is still a good investment. Okay. But is it really affecting you? Well, the one thing it's affecting is oil. Okay. Because the Strait of Hormuz is so small and so much of the oil goes through that. So it's all supply and demand. So is it good or bad what's happening in Iraq? Well, I think it's from a humanity point of view, it's not very good. But at the same time, how does it affect you? Well, it affects you on what everything costs. But I want to talk to you about a thing that's called dollar cost averaging. And this is, I'm going to use the example, and because of it's really easy to use the number 100. This could be 100,000, 100 million. It could be 1,000. It doesn't really matter. It's just very simple to be able to use. But if you had 100 of something to invest every month, okay, you're going to take 100 of that and you're going to invest in it. And let's say that there's a stock that's trading at say $5 a share. Okay, so that's the cost, and the number you can buy would be 20. Okay, so 100, you had $100. That equals 5 times 20 of them. Right? So you spent $5 and you got to get 20 shares. The next month, the stock goes up to $10. Well, guess what? You can only buy 10 shares then. You can only buy 10 shares because the stock went up. The next month, the next year, it went up to $20. Okay, you can only buy 5 shares. Let's say that it went back down to 10. Well, you can buy 10 shares. Let's say that it went crazy and went all the way back down to 5. Well, it gets you 20 shares. Okay, so you're on the roller coaster. The question is, when are you selling? If you're trying to time the market, that's very difficult to do. It's very, very difficult to do. In fact, I don't suggest you do it. Suggest spend most of your time in step number 1, which is your business, and number 6, which is your real estate and turning your small business to a large business, and then let all this done in the background and passive. But if the stock is going to go back up to 10, you get 10 shares there. And let's say that 5 years from now, these are years, 1, 2, 3, 4, 5, 6, we're at 7 years. And let's say that the stock is back up to 20 and you're able to buy the stock, you'd only be able to buy 5. So you can see that as you look at the number of shares that you were able to buy, there's 15, there's 35, 45, there's 50, 60, there's 80 right there. So what's the average? 1, 2, 3, 4, 5, 6, 7, 700 right there. Okay. So what we're trying to say is that if you sell when the stock is low, then you're probably going to lose on it. But if you're holding on to it till it goes up, then you were able to buy it. This was a great time that you bought. That's a great time you bought. That's a great time you bought. That was an okay time because that's what it's valued at right now. This was a great time. That was a great time. So the real question is, when are you selling? If you're trying to time the market and figure out that I'm going to sell it next Thursday or today, and I'm buying and selling and stuff like that, the vast majority of people don't do well with that. Okay. The vast majority of people don't do that. Follow people that do well. Follow Buffett. What does he do? He doesn't do that. What he's doing is he's buying wonderful companies at wonderful prices. Because let's say that there was the war going on. People are going to get up tomorrow morning and they're going to buy a Coca-Cola and they're going to drink a Coke. They're going to shave. They're going to put on underwear. Okay. It doesn't matter what's going on in the marketplace. And those are the kind of companies that he loves to buy. He loves to buy those companies because it doesn't matter what's going on around the world. It's not going to affect the supply and demand. The supply is that people are going to do these things. And so that's the companies that he wants to buy in. So the dollar cost averaging, the point to you going back here to our chart here is sometimes the market is going to be up, sometimes it's going to be down. But over a period of time, because of inflation, it's going to be more in the future. Now, if everybody paid all their bills and we had no inflation, then we'd talk about a different strategy. But the government has to have at least 3% inflation to make its numbers work, a minimum of 3%. Because they can't pay their bills. So they're printing more money. They're causing inflation. So over a short period of time, can it go down? Sure. If you're buying one stock, that could be volatile. If you are involved with multiple companies, 400 or 500 companies, or even Berkshire Hathaway has a whole bunch of cash, over time, it should be higher because of inflation. Because of inflation. Now, inflation is a two-edged sword. We either appreciate it. If your house is going up in value, if it's going up in value, we either appreciate it or it's inflation. I'm looking at houses, because that's one of the fun things we're doing right now. Most of the investing I'm investing with big partners. We do big $100 million deals, and I'm just a small part of a group that does a lot of that because I'm spending so much time in the foundation now. But because of inflation, we appreciate it because it's going up in value. You have to have assets that go up in value. Inflation is when everything costs more. Rent, utilities, food, all those things cost more money. And as a result, if you don't own any of these things, you're getting harmed. We appreciate inflation because it makes people, the rich are getting richer and the poor are getting poorer because the rich have assets that go up in value. So going back to the real question, is it good or bad with what's going on in Iran and Iraq? Well, does it affect you? Well, it might. Does it affect the supply demand? Might. How do you take advantage of it? That's what you're going to be asking yourself. But most of the time, it's not going to affect where you're going. And also, you watch TV and you hear all these crazy things that's going on. Remember, TV, social media, all that stuff, their job is to get eyeballs to watch what they're doing. They're trying to watch what they're doing because they're selling advertising. So one of the first things I do is I don't watch it. Okay. It doesn't make any difference to me what's going on. I'm looking for great deals and I'm always hunting and always looking. I'm looking, I drive around, I'm always looking at stuff because it's part of the game and games are fun. So is it a good thing or bad thing if the stock's going up or down? Well, it all depends on when you're selling. If you're going to sell tomorrow, well, then you could probably be less aggressive. If you're going to sell in 5 years from now, if you're young or in 5 years from now, like part of our teams in their 20s and 30s, boy, I'm on the roller coaster. I don't care. I mean, it's great. I'm 67. I'm not on the roller coaster. I'm on a scooter. That's more bonds and stuff like that because I don't need to anymore. So it's really where you are in the place. So hopefully that's a little bit helpful. Is it good or bad? Well, dollar cost averaging, the key is not timing the market, but time in the market. So the earlier you can start investing, the more money you can put into the long-term investing. And I'm looking 5 years down the road, 10 years down the road. And if all the governments of the world balance their budget and start paying off the trillions of dollars that they have in debt, we'll do something different. But until that